Bienvenidas y bienvenidos nuevamente. Seguimos en el marco de las Jornadas Monetarias y Bancarias 2020, en este caso con el próximo expositor del primer panel de las jornadas, el profesor Mehrling, que nos va a dar una exposición sobre el impacto del coronavirus como una prueba de estrés financiero. Mi nombre es Germán Feldman, soy el economista jefe del Banco Central y en esta actividad va a participar también Fernanda Martijena, que es gerenta principal de análisis macroeconómico y monetario en el área de investigaciones económicas. Mehrling es profesor de Economía Política Internacional en la Pardee School of Global Studies de la Universidad de Boston, donde imparte cursos sobre dinero global. También es miembro principal del cuerpo docente del Global Development Policy Center. Previamente fue profesor de Economía en el Barnard College de la Universidad de Columbia. Estudió Economía en la London School of Economics, donde obtuvo una maestría en Econometría y Economía Matemática en 1983. Luego obtuvo su doctorado en Economía en Harvard University. So, Professor Mehrling, the floor is yours.
This has been quite a crisis starting in March. I'd like to back up and put it in larger context of the evolution of the financial system, the international financial system. A long context, as you can see from this slide, of financial innovation after World War II, and a changing the changing nature of liquidity in the global system and the changing relevant price of liquidity in the global system. You can see there that I'm suggesting that in 1950, the world was much simpler. We were dealing with a world of monetary liquidity, and the key price of liquidity was the differential between the money rate of interest and the zero interest on cash deposits. And a lot of economic theory was built around that world, and it still lives in the textbooks, but it doesn't live in the world, okay? The world kept moving on. Right about 1980, or perhaps a little earlier, we were very much in a world more of funding liquidity, where instead of using monetary reserves, this was about borrowing and lending, Fed funds market, the Eurodollar market, and is where the marginal source of liquidity was in the global system. And there you could see the price of liquidity emerging in the failure of certain arbitrage relations that theory suggested should be holding, but were not, the expectations hypothesis and uncovered interest parity for exchange rates. But the world kept changing even more. And I think today we're in a world where the marginal source of liquidity is market liquidity, where you are meeting your settlement constraint through asset sales or through using assets as collateral for borrowing. So collateral valuation is the key. And again, there's a shift in where the price of liquidity, the global price of liquidity shows up. Much more today, as you'll see in some slides, in the failure of forward interest parity and even the failure of covered interest parity, which are big surprises to economists. But there you go. We're living in a new world, and we're trying to adapt our management. You know, we are aware that all central bankers are aware that of the inherent instability of credit. So even though we have financial innovation and it's developing over time, the form of that instability changes over time, and we're adapting to this new world of market liquidity and building some new financial infrastructure. And I would just suggest that there are sort of three steps to that journey. The first step is kind of the last, finding what is the equivalent of the lender of last resort. And it is a dealer of last resort because it's market liquidity, not lender of last resort. And we're developing a two-sided dealer of last resort at the central bank as a backstop for this system. That's a first step. But of course, a central bank doesn't want to use that facility in a regular basis. So you need to ramp up the private dealer system of first resort in order to facilitate small shocks so that you don't have to always be going to the central bank. That would be the second step. And then once you've dealt with this last resort thing, you need to think about how to manage the system in order to try to avoid getting to that point in the first place. What are the management mechanisms? How do you control the price of liquidity? How do you influence the system? And so I want to use this Corona crisis as a stress test of this emerging new financial infrastructure and suggest to us, where are we on this journey of building a proper financial market infrastructure for the brave new world of market liquidity? I remind you that this isn't the first crisis we've had in this brave new world, that the first one really was the 2009 global financial crisis, and that there was a regulatory response to that crisis of various kinds. And I just mentioned a few of the more prominent things that were done, moving a number of these markets onto central clearing platforms, central clearing counterparties. The Volcker rule, which was an attempt to get speculative dealing out of banks so that the taxpayer would not be on the hook. And what for at the level of abstraction that I want to talk today, what we see emerging from the regulatory response to 2009 is extending the lender of last resort to dealers, not just to banks, okay, and adding this new function to central banking, which is dealer of last resort to markets, supporting markets directly. And I have suggested in previous work that we can think of what's happening is the emergence, from the point of view of the central bank, we are adapting the old time budget rule. Budget rule will be familiar to all of you. Lend free in a time of crisis, lend freely at a high rate to against any asset that would be good in normal times. And I think we're adapting that for this brave new world of market liquidity. And I've suggested that this is about supporting, at times of crisis, supporting markets, not institutions. That you're making an outside spread, not an inside spread. So that's the equivalent of the high rate version. You're supporting only a core set of assets, not periphery. You're focused on liquidity, not solvency. That seems to be emerging in practice, this new budget rule, as I call it. So let's see how that did, okay, in this Corona crisis. Well, you can see the Fed really did intervene very, very quickly and very aggressively once starting March 15th with these central bank liquidity swaps. I'm listing a few of these interventions: Treasury bond purchases. It lowered the policy rate. 2 days later, it did some more things. A week later, a monetary authority repo facility, and then a week later, extending to corporate credit facilities. There was not only very rapid intervention compared to the global financial crisis, very large intervention, and many of these facilities were just reactivated from after the 2009. But there were some new things, and I want to pay particular attention to them. So this was a crisis that came from the effect of the Corona crisis on the financial system, and it was a stress test. It was, in particular, I like the word, the dash for cash. Which was a disruption of the global supply chain. My friend and colleague James Sweeney at Credit Suisse coined the phrase, "A supply chain is a payments chain in reverse." The supply chains were disrupted, and so were the payments chain. And so there was a dash for cash. Many corporations wanted to build up their precautionary cash balances because it wasn't clear what was going to be happening, and you need to be meeting your payments, promised payments. And the attempt to do that dash for cash in the banking system and in the financial market is what caused that crisis. Basically, the first resort dealer system that we had set up after 2009 was very rapidly overwhelmed. One reason was there was an existing large holding of inventories of treasury securities, and they didn't have the balance sheet space to absorb a lot more. Also, the funding of dealers was a problem because the banks were meeting their contractual corporate revolver credits, and they were not interested in lending more to expand the balance sheets of dealers. And the dealers did not have this routine access to liquidity backstop, and so they stopped making markets, and there came to be air pockets, and there were problems. And the symptoms that I'm going to talk specifically about were some very strong deviations in the FX swap basis, treasury market dysfunction. This is supposed to be the deepest and most liquid market in the whole world. So these are government treasuries, US government treasuries, and corporate bond market dysfunction as well. Those are the three that I want to focus on. In all three, the Fed intervened as the global dealer of last resort. And let's look at that. So the data that I'm giving you here is not mine. It's all from the BIS, and put out these bulletins in a very timely fashion for those who could follow this to understand what was happening, why the Fed was doing what it was doing. Here is the movement of the FX swap basis. Covered interest parity says that there shouldn't be a swap basis. So we see this as the price of liquidity in the modern market liquidity world. You can see there the financial crisis of 2009, you can see the Euro crisis, and then you can see the Corona crisis. And you can see that vertical bar in the right-hand panel there. That was the announcement of the Fed of these central bank liquidity swaps, and you could see that it averted the crisis, okay? That the central bank was going to come in, and so the looming crisis was calmed down immediately by that intervention. I'm not going to spend any more time on that because I want to specifically talk about the Treasury dysfunction, which is a new sort of thing, where apparently, and we're going to see why, there was a great liquidation of Treasury holdings. The dash for cash was about, I'm not interested in holding a safe asset, the safest asset in the world, the Treasury security. I actually want cash. And so they're trying to liquidate these, sell them, and that led to this spike that you can see at the end of those diagrams. And the question is sort of why? What was this all about? And I think there we get to some deep information about the new system as it's being developed. This was basically largely about the liquidation of a particular kind of trade, sometimes called the cash and carry trade, that was being done by hedge funds mostly. And they were taking a long position in Treasury securities, which were financed by short-term repo. And then they were taking an equal and opposite position in Treasury futures, and settling at the repo maturity date. This was in effect a synthetic forward hedged with matching futures. If there were full carry pricing, there would be no profit to this, but there was a deviation in the prices of treasuries and the prices of futures, a basis that the hedge funds were collecting, a very small one. So this was being done in volume. It's not clear whether they realized or not that sort of trade was exposing you to large market liquidity risk. In effect, they were supplying market liquidity to the market because of the mark-to-market feature of the futures, the short leg of this, and they got exposed to liquidity risk. And so when there was this liquidity shock, that all went against them, and they had to make these payments, and they couldn't make these payments, so they liquidated the trades, and that means selling the treasuries. So that was the source of this sudden switch from supplying market liquidity to the market, to demanding liquidity by liquidating your treasury securities. And this is why the Fed stepped in to buy those treasury securities, basically taking them off the balance sheet of the dealers that were stuffed full and giving more room for supporting other markets. So this is the treasury market. Here's the third one, the disruption in the corporate bond market, that I want to draw to your attention. Again, this is from one of the BIS bulletins. This is again a price that really should be right at zero, and you can see the disruption there. You can download this yourself at the BIS website and read the paper. What I want to specifically emphasize here is that there was this disruption in these electronically traded funds, and there's a balance sheet of these bond electronically traded funds, which are holding a portfolio of corporate bonds as their and relatively illiquid, some of them, corporate bonds as their assets, and issuing shares in that portfolio as normal mutual funds do. What makes an ETF different from normal mutual funds is that these shares trade constantly. So the idea is that they're in fact offering liquidity to people who normally in normal bond funds would get the end of day NAV if they wanted to sell a share. Here they're trading constantly, and so here's what happened. Okay. That the net asset value on the asset side is based on the stale market price of illiquid bonds that don't trade very often, okay? But the ETF price on the liability side is based on the current price of ETF shares, which is liquidity driven. So Whoever was holding those shares with a notion that they were liquid assets tried to take advantage of that in this dash for cash by selling those shares, driving the price of those shares down below net asset value, but also forcing the bond ETF, okay, to sell some of these corporate bonds into illiquid markets. This is the transmission mechanism for this dash to cash to disruption in the corporate bond markets. The idea again here is that these prices should be the same, the NAV and the ETF, that there should be an arbitrage that holds them together. But we can see in practice that this is an exposure to liquidity, and there's a liquidity premium that can open up between these prices, and in a crisis, it did. And the Fed stepped in, and here's those Fed interventions, and I'm just classifying them by what was the nature of this, what was the nature of the intervention from the point of view of this new dealer of last resort idea for market liquidity. So I'm putting showing you the FX swap basis. I mentioned taking the dealer inventories off the balance sheet in order to give more room for dealers to support other markets. Money market dealer of last resort, and then global money market dealer of last resort, the FEMA repo facility, and then April 9th, extending this support to corporate bonds really for the first time. This is a new feature of dealer last resort that was invented on the fly in April 9th. So there's a few things that happened. What can we learn? I think one of the most important lessons that I would emphasize is that even in normal times, liquidity risk is being priced, okay? And we see this in the fact that even in normal times, the FX swap basis does not go back to zero, okay? That even in normal times, there's a little gap between futures and forwards and treasuries. That's a price of liquidity. That even in normal times, we would not expect the ETF price and the NAV to be equal to each other in these corporate bond markets. In crisis times, the dealer of last resort caps the price of liquidity. That's exactly what the Fed was doing, was as these prices were moving away from each other, putting a bound on that. That's what I call the outside spread. That enabled dealer exit. It enabled people who are acting as dealers, hedge funds who are acting as dealers, to exit. And so we have this concern about moral hazard. Did they imagine that this was going to happen? And is that why they were taking too much risk? It's the same question we have for the old Bagehot rule that we're going to have for the new Bagehot rule. So we're thinking about a lesson to learn is the new Bagehot rule enough in a crisis, or is it too much? Markets, not institutions, but is the implicit liquidity insurance underpriced or unpriced? Outside spread, not inside spread. Is 25 basis points too tight in an FX swap basis? Should it be 50? Should it be 40? Core, not periphery. Note that we extended from treasuries to investment grade and even high yield corporate bonds. This is a big extension of the eligible collateral in times of crisis. Liquidity, not solvency. There was no direct support of the emerging markets that ran into debt crises. Their own central banks did some kind of dealer of last resort. That's becoming clear. I'm not an expert on that, and I'm hoping that we will discuss this in this conference and other panels, and I will learn about this, what was going on in the emerging market worlds. I'm talking about the center of the system, the Fed, and also the other large central banks, the Bank of England and the ECB and so forth, as this crisis moved into a global crisis. So I return to the question that I started with. Where are we on this journey from getting a lender of last resort support, trying to build a robust infrastructure, and then trying to figure out what are the right mechanisms, what are the right tools, what are the right ways to think about managing the inherent instability of credit for this brave new world of market liquidity. Okay. I put it to you when I look at the Corona crisis that the central bank is pretty much on top of the first step. Central bank as a two-sided dealer of last resort. Okay. The system did not collapse. It did not even come close to collapse. The central bank of the United States acted as a global central bank very, very rapidly. And there may be some political fallout from that, okay, in the United States. But I'm saying from a central banking point of view, where the first step seems to be established, okay. The second step is obviously still needs work, okay. There were market institutions that broke and that were not expected to break, and broke for reasons that we can now understand in retrospect as we are putting the system back together. And I don't think we're thinking at all really about the third step, about actual sort of monetary management of this integrated global system in normal times. The price of liquidity as a tool for countering the inherent instability of credit is, I think, we're still just dealing with fighting fires as they come along. And I suppose that's natural, but it seems to me that's where we should begin to start thinking for the future. That's the lesson I take from the Corona crisis.
Okay, thank you very much. I wanted to ask you some question. Given the Fed's role of global dealer of last resort, what can emerging markets expect from the unwinding of these liquidity mechanisms taking this year, especially in a world that might be structurally changing?
Well, so I'm not an expert on emerging markets, but I do read the Financial Times. And so I am aware that one of the things that happened in this crisis was that asset managers in the global north liquidated. Just as there's a dash for cash in liquidating corporate bond holdings and treasury bond holdings, there was also a dash for cash in liquidating holdings of sovereign debt and other emerging market debt. Some of it dollar denominated, some of it local denominated. What happened, my understanding is that what was new here is that there was some backstop for these markets from the emerging market central banks, who were themselves backstopped possibly, or had some informal arrangements through swap lines with other countries. I don't think most of them had swap lines with the United States, with the Fed. But there is emerging what I see happening is an emergence of a kind of global network of central bank support, mutual support, that has this hierarchical structure to it. It's a core periphery kind of structure, but that doesn't mean to say that the periphery is left completely on their own, but even if they're not in the center, and that is a fragile, there's things to learn from looking at what happened, and I think it was differentiated. Argentina had a different experience than Brazil, than India. That would be very useful to have a look at and think about what have we learned for building a global dollar support infrastructure going forward. I haven't done that study myself, but I think that's very crucial. We are living in a global dollar system. Argentina lives in a global dollar system. What is the interface between the Argentina economy and that global economy? This needs to be refined and further developed.
Professor Mehrling, after the global financial crisis in 2008, we have witnessed changes in the regulation, in banking regulation. You have shown in your presentation the reaction of the Fed as a dealer of last resort, and how the global financial system reacted to the coronavirus crisis. My question is, we have other relevant actors in the global financial system, which are the non-banking financial institutions that have played a growing role in recent years, and in which we have not seen significant changes in the regulation of these market participants. Do you think we should advance in the regulation of these non-banking financial institutions, like, for instance, these hedge funds that you mentioned, or global liquidity funds?
Short answer, yes. Most certainly, and that does follow from the analysis that I was just putting forward. Perhaps I should have said that explicitly. So I thank you for making me clarify that. we should remember that in 2009, this was really a stress test of the new market-based credit system, sometimes called shadow banking. I like to point out that this is sort of money market funding of capital market lending. So it has the same kind of maturity transformation, liquidity transformation that we're used to in the bank-based system. But we're not exactly sure where the instability comes from or how to backstop it. And so it is exactly right what you said, that the new regulatory changes after the global financial crisis more or less said, well, we don't really understand shadow banking. We maybe hope that it's going to go away, and so we don't have to worry about it. So they were really focused on making traditional banking safer, okay, and safe from a crisis of the non-banking intermediary world. And in fact, that worked, okay? It did in this crisis. That basically we didn't see the crisis moving into the traditional banking world, but it was a crisis nonetheless. So this is telling us that yes, we punted back in 2009. That's American slang, I'm afraid, meaning that you don't really know what to do. You're not making progress on the football field, so you give the ball to the other team and see what happens. Well, what the other team did was to build out this market-based credit system into the global south, as a matter of fact. And now we are really having to confront this and think about what is the right way to stabilize that system, to put some bounds on it, because I think it's here forever. Not forever, nothing's forever, but that the wish that maybe regulators had 10 years ago, that it would just go away, okay? It is not going away, okay? This is the nature of modern global credit, and so we need to confront that and think about what is the best way to intervene, to stabilize the inherently unstable credit system that is focused on market liquidity.
One last question. Do you think that all the experience of this year will change the way of conventional thinking of monetary policy?
Do I think that we have changed it or that we must change it?
Do you think we must change?
Yes, I think we must. Yes, I do think, and financial innovation is being driven by private interests and by profit-seeking interests, and the central bank reaction is about stabilization interest, is about public interest. So, and then economics follows after all of that. So economic theory is always a lagging indicator of what's happening in the world. But I think that what economists should be doing is paying very close attention to what's happening in the private innovation, how that's changing the world. Central banks are forced to pay attention to that because of their role, but economists, academic economists like myself, should pay attention to that as well and realize that the models that we know and love and have been teaching for 50 years, okay, are not really grappling with the world that as it appears outside our window, okay? And so we need to do some economic thinking, new economic thinking, and that's a good thing. That's an exciting thing for me as a professor, and I think for young people entering the field and perhaps watching this and trying to think about what they want to do with their lives, there are some really quite hairy intellectual problems here, okay, that are going to need some attention over the next decades. Anyone who specializes in this is going to have full employment in their own personal life. This is a problem that we need to really be focusing on. And I think that was one of the lessons of the Corona crisis. It's true we know about dealer of last resort, that the Fed jumped in quickly, but what about the emerging markets, as you said, or what about normal times? This is barren ground which we haven't really delved into very much at all, and it needs attention. I'm glad you brought that to our attention.
Okay, Professor Mehrling, thank you very much again for your very interesting presentation and the discussion.
Good to be here.